Hello and welcome to SKANS ECampus. SKANS ECampus is a gold-approved learning partner of ACCA. On this channel, we bring you demo videos of different courses available at SKANS ECampus. So don't forget to subscribe to our channel to get notifications of additional videos and hit the like button.
Hello guys, and today we're going to be discussing about a very important topic called the interest rate risk management. And in our previous video we had just discussed about the currency, and in this video we're going to be talking about another risk, that is the interest rate risk. And it is the most important, one of the most important topics that we need to cover, because students often get confused in interest rate risk management, and especially related to questions related to hedging, which is safeguarding ourselves against the interest rate risk. Now, what is the interest rate risk? That depends upon whether you are a lender or whether you are a borrower. So, if you are a lender, your interest rate risk is that what if the market interest falls? So you want to deposit somewhere and you're looking at the accounts and you're fearful that what if the interest rate drops and I may not be able to attain a lot of profit. On the other hand, the other risk that I can face is borrowing. What if the interest rate increases? So I'm thinking of borrowing, let's suppose 10 million pounds, and I'm fearful and I want to borrow them in 6 months time, and I'm fearful whether the market rate will increase. So if currently the market rate is 5%, and when at the time of borrowing the market rate becomes 8%, so I have suffered a loss of 3% by not acting quickly. As a result, I need hedging for my interest rate risk, depending upon whether I am a lender or a borrower. So to be excellent in this topic, the first step that you need to know about is you need to know your forward rate agreement. What is an FRA? So what is an FRA? FRA is when two parties determine the rate of interest to be paid on an agreed upon rate. So a borrower and a lender agree that we will borrow and lend each other, let's suppose 10 million pounds, this is an arbitrary number where we have assumed, at a rate of 6%. So this agreement that we will lend and borrow 10 million pounds at 6% in 7 months time or 8 months time or whatever the time is, this is called an FRA agreement. And in such agreements, rather than the actual transaction taking place, it is settled. Cash is settled with the payment based on the net difference. So what do we mean by that? Basically, so if I'm a borrower and I've agreed to borrow a loan at 6% in 7 months time. Now when 7 months hit, the market rate has reached, let's suppose, 8%. The LIBOR, the London interbank borrowing rate, has just reached 8%. So I have benefited. Why? Because I have agreed to borrow at 6%. So as a borrower, I have just gotten a gain of 2%. And as a lender, I have just gone a loss of 2%, because now I could have lent from the market at 8%, but because I agreed on a contract 8 months or 7 months ago, now I can only get 6%. So as a result of such transactions, you get a plus or a minus percentage gain. Now this gain, when is translated into cash, and result, rather than completing the entire agreement, if there is a gain to the borrower, the lender pays a 2% per annual interest gain to the borrower. On the other hand, what if the interest rate becomes 5%? In such a case, the borrower has gone a loss of minus 1%. Why? Because if the borrower had not entered in this agreement, from the market he could have borrowed at 5%. But since he entered this agreement, he has to borrow at 6%, so he's gotten a loss of minus 1%. And the lender has gotten a profit of 1% increase. Why? Because if he had not entered the contract, he would have only been able to lend at 5%. So he has gotten a gain of 1% by lending at 6%. Now, in such a scenario, the borrower will pay the lender annual installments of the percentage gain. This is called cash settlement. Rather than conducting the entire loan, you just pay the specific percentage change and you settle the differences. So if you understood what I have said up till now regarding the forward rate agreements, you should add a tick mark over here and you should be happy that you've understood this concept. If you have not, it is a time to pause and either Google it, and while Googling it, I will recommend that you just write forward rate agreement and ACCA in your Google search bar, and they will show you some ACCA global articles which very much clarifies the concept of forward rate agreement. But if you are still confused, then you have always the option of emailing me. Now the second tip that you need to know regarding a forward rate agreement is this very simple language of if a contract is written 3/6 or something like 3/6 or 3/9 or something like 3/9. So what does these symbols mean? So if it is written 3/6, it means that it's a 3-month loan beginning in 3 months time. So the trick is you take the higher value, which is 6, and you deduct -3 out of it and you will get 3. So the first value, that the first number that is showing after how many months the loan will begin. And the second value helps us to determine what is the duration of the loan. So 3/6 means the loan will be initiated after 3 months, and 3/6 means 6 minus 3, and the loan duration will be of 3 months. Similarly, if it is written 3/9, it means that the loan will begin after 3 months and the duration of the loan is 9 minus 3, which is 6 months. So the duration of the loan is, it's a 6 months loan which will begin in 3 months time. Similarly, if it is written 1/4, it means that the loan will begin in 1 month's time, and 4 minus 1, which is 3, that is the duration of the loan. So it's a 3-month loan which will begin in 1 month's time. I'm telling you this tip, this language is very important because often in ACCA past paper questions, just because of not understanding what this means, students have made mistakes which have cost them around 15 to 20 marks. So knowing this word, this terminology is extremely important, especially this is used in FRA's contracts. Now after you have gotten this and you are clear about this, I'll give you a thumbs up and 2 ticks. The third thing that you need to know is how to calculate the net cost or the effective cost in an FRA agreement. So calculation is also very important. So let's take an example that you need to take a 10 million loan for 6 months and it needs to be taken in 3 months time. So you're thinking about taking a 10 million loan for 6 months in 3 months time, and you are fearful that the interest rate will increase. That is so if you are fearful that the interest rate will increase, that means you are a borrower, because only a borrower will be fearful of the increase in interest rates. A lender will never be fearful of an increase in interest rates. So that indicates that we are a borrower. So if such a case arises, we will take an FRA of something called 3/9. So in a question, you will be given an FRA of, let's suppose, 3/6, and FRA of, let's suppose, 3/12. So now you are given 3 options often in questions. So you need to decide which FR is most suitable. Since our loan is for 6 months, That means the duration should be 6 months and it needs to be initiated in 3 months. So this FRA gives me a duration of 6 months. This FRA gives me a duration of 3 months. This FRA gives me a duration of 9 months. So as a result, FRA 39 is the most suitable forward rate agreement for me. Why is this not suitable? Because this will make me underhedge. So it's only covering 3 months period of my duration of the loan. This is will overhedge because it's covering 9 months of the loan. So I don't need a 9-month loan, I don't need a 3-month loan, I just need a 6-month loan. As a result, I will select this percentage. Now I selected this and I entered that agreement as a borrower, which means that I've agreed that after 3 months I will take a loan of 10 million at an interest rate of 6% for 6 months. Now at the time of initiating of the loan, what happens that my interest rate, market interest rate, or we can say LIBOR, increased to 6.5%. So I have agreed to borrow at 6% and the market rate has shifted to 6.5%. So that means I have gained. Why? Because if I had not entered this contract, I would have had to take a loan at 6.5%. So to calculate the loan, you will write 6.5 minus 6 over, so you just write the percentage as well, multiplied by 6 over 12. Remember, these interest rates are given in annual terms, but our loan is just for 6 months. So the gain can only occur for 6 months. So I will write 6 by 12 and I'll multiply by the loan amount to get the gain. So the formula is to write the percentage change multiplied by the months or the duration of the loan into the amount of loan. So the percentage change was 0.5%, which was positive, multiplied by the duration of the loan, which was 6 by 12 for 6 months, multiplied by the amount of loan, which was 10 million pounds. As a result, I will get a value of 0.025 million. Now this is my settlement. This is what I was referring to, tip number 1, which was related to cash settlement. Now when I talk about the loan interest payment, so I have not actually executed the loan. At the point of 3 months, the lender and the borrower will settle the loan. So in essence, the gain that I will get from this contract of FRA is 0.025 million. Now I will enter the market and take up a loan at the actual amount. So the actual interest rate, which is 6.5%. So my loan in actuality will be initiated at 6.5%. The contract that I had just been finished off when the lender gave me this gain. So I took a loan, so 6.5% into 6 by 12 into 10 million, and I will get a value of 0.325 million pounds. So 0.325 million is my, so 0.325 million is the payment I'll have to make in 6 months time on the interest rate, minus I'm getting a gain, so I will be deducting this gain of 0.025 million, and as a result I will get, sorry about this typo mistake, I will get a value of 0.30 million. So in essence, because of entering this contract, the interest payment that I have to make is 0.3 million pounds. If I had not entered this contract, I would have to be paid 0.325 million pounds. So definitely a 0.25 gain has just occurred to me just because of entering this FRA agreement. So I need you to pause over here, and as an exercise, just do the calculations of what if the interest rate was 5%, 7%, 4% and 8, and see how much total payment you are calculating. This is an exercise that needs to be done, And if you are still unclear about the step number 3, please email me so that I can further clarify this concept to you. Now what if the interest rate decreased to 5%? So we just did an increase to 6.5%. What if it decreased? So I'm a borrower, and if the interest rate had decreased, I would have gotten a loss in my FRA agreement. And how much would have been the loss? Similarly, 5% minus 6% multiplied by 6 by 12 into 10 million pounds, which would have given me a loss of 0.05 million. Now, when I start the contract of loan, which I will do at the market rate, because now my FRA agreement has been settled. So when I calculate the loss, that means I will pay this loss and my contract is settled. As a result, I will now take a loan from the market at 5%, and so the loan payment for 6 months will be 0.25 million. So what will be the total cost to me? Since I have to also pay a 0.05 million loss, so my total cost will be 0.25 plus 0.05 million, and it will be 0.255 million pounds. So when you enter a FRA contract, it is not sure shot that you will get a profit or a loss. But if you could get either a profit or either a loss, so there is no guarantee that you will only get a profits, or there is no guarantee that you will get only losses. So this needs to be cleared, that in an FRA you could either get a loss or either get a profit. There is no certainty in it. So another way to hedge our interest rate risk is, rather than entering an FRA agreement, is that we purchase or sell interest rate futures. So it is very important that you know what is an interest rate future. An interest rate future gives the owner either the right to earn interest at a given rate or to pay interest at a given rate. So this interest rate future is more standardized. It has a fixed contract size. So normally, like, it has a contract size of, let's suppose each future consists of 500,000 pound contract. So something like that. So, but it is similar to an FRA agreement. The only difference is you are doing it in a standardized market. In an FRA, it is more customized. So you settle in, the owner of an interest rate future settle in either to earn interest, or either to pay interest. So you have two positions that you can take in an interest rate future. If you take a sell position interest rate future, basically you want to pay interest at the specific rate. So if you take a sell position at the interest rate future, which is trading at 8%, that means you are agreeing to pay interest at 8%. If you enter a buy position at 8% future, that means you are agreeing to receive interest at 8%. So remember, a sell position is taken by a borrower. A buy position is taken by a lender. And when does a borrower take a sell position? When he is fearful that the interest rates will increase, not fall, but increase. And a lender will take a buy position in interest rate future when he thinks that the market in the interest rates will fall. So remember these two positions. These two students often make this mistake when understanding the sell and the buy position. The next step that we need to be very clarified about is price and the interest rate future. What is their relationship? Remember, whenever the market interest rate increases, the price of that interest future decreases. And whenever the market interest rate falls, the price of the interest rate future increases. For example, you have a future which is giving you a loan at 5%. So you have a future which is giving an option to take a loan at 5%. Now the market rate has just become 6%. So now if the market rate has become 6%, from the buying perspective, so who is the buyer of future? Buyer of future is a lender. So from the lending perspective, if you have settled for 5%, while the market rate has shifted to 6%, that means this contract of 5% has become less attractive. So this contract has become less attractive. As a result, that means the price of future will fall. Similarly, hence, to understand, the price of the futures are quoted in 100 minus R. So if you want to understand what is the interest rate at which the future is being quoted, what interest rate is being used for that future, you just simply, if for example it is written 96, a future is quoted 96, that means 100 minus R is equal to 96, R is equal to 4. That means this future rate is asking us to settle or agree on interest rate of 4%. So this is some formulas that you need to understand for understanding what interest rate that future is agreeing upon or settling upon. So I hope this concept is clear. Remember this point, that when a market interest rate increases, the price of future falls, and when the market interest rate falls, the price of the future increases. And the reason is very simply that when interest rate increases, the future which is settling at a fixed rate becomes less attractive. Now, if you are fearful that the interest rates in the upcoming months will decrease, so who will be fearful? The lender. So as a lender, to hedge that risk, you will take a buy position in futures. And since just like FRA, you have to settle it down, so to close the deal of an interest rate future, you have to take an opposite position like we did in currencies as well. So if I have taken a buy position, to close the deal, I'll have to take a sell position. And similarly, if you're fearful that the interest rates in the upcoming months will increase, that means who is fearful? The borrower is fearful because he doesn't want the prices to increase. In such a case, you will take a sell position and you will close the deal by taking a buy position. So another important tip that you need to have a clarity. What are we trying to say? Let's suppose the interest rate currently is 4%. So if the interest rate is 4%, the future will be operating at 96. 100 minus 4 is equal to 96. So the future is currently will be trading at a price of 96. So you buy at 96. Now the interest rate falls. So if the interest rate falls, that means what? So the future has become, the price of that future has become, so what if the interest rate goes to 3%? That means 100 minus 3 is equal to 97. So now you will, at the time of closing the deal, you will sell at 97. So you bought a future 96, sold at 97. That means you got a gain of 1 point, which will be, I will show you how to convert it into ticks. On the other hand, if I take the same position from the borrowing perspective, that at the time of the agreement, the future was, the market rate was 4%. So that means the future would be at 100 minus 4, that is 96. And at the time of closing the deal, the future was at 5. So that means 100 minus 5%, that is 95. So you sold the future at 95 and bought it back at 90. So you sold the future at 96 and bought it back at 95. That means you got a gain of 1. So now you've understood that you will, in a buy position, buy sell position, you'll get a gain when the interest rates fall, and in a sell buy position, so you initially took a sell position, and to close the deal you took a buy position, you will get a gain when the interest rates increase. I will recommend that you pause the video, you understand this concept, you repeat this video again, and try to mathematically see what happens if I've taken a buy position and the interest rates increase or decrease. Do it mathematically yourself and you'll get more clarity. The other thing that you need to know about, which is very important from the perspective of your questions attempting, is basis risk and closing future rate formula. So basis risk basically tells us that the current spot rate will eventually converge to our opening future rate. And the difference when the spot rate and the future rate has not converged is called the basis risk. So you need to understand this formula. Why this is important? Because this formula will be required to calculate your closing spot rate. And similarly, when we're talking about the remaining basis, so what if you took an FRA with the objective of 6 months duration, and after 3 months you decide to close the position? So you took a future with the perspective of 6 months in mind, or the future contract was giving you a hedging for 6 months, and after 3 months you want to close the position. To do that, the first step is you have to calculate the remaining basis. What is that? First of all, the difference that I'm referring to over here is basically the basis risk. You take out the difference, so you write difference over the total number of months during which this basis risk is occurring, which is 6 months, and you multiply it with the remaining months left. So if I'm closing at 3 months, the remaining months left are 6 minus 3, and as a result I calculate a value which is remaining basis. Now I will add that value in our closing spot rate, which is the spot rate at the time of closing, to get our closing future rate. Sorry, this is called a future rate. So this is not spot rate, this is future. Closing future rate is calculated by knowing the closing spot rate, which will be given in the question, and adding the remaining basis, which I have just shown you how to calculate using the formula. If you have confusions, it is recommended that you either email me or you try to solve some of these questions. So attempting and practicing is very important while understanding these concepts. So let's take an example to clarify it further. So what if at the time that I wanted to take future, the spot rate LIBOR was 6%, and the future rate 3-month LIBOR is currently given at 93.79. So what does that mean? So if the future rate of a 3-month is written 93.79, that means 100 minus 93.79 is equal to 6.21. So 6.21 means that the 6.21 interest rate. So the loan to borrow or lend is given at a 6.21%. So since I want to take a loan, so I will have a sell position. So I have taken a loan at 6.21% using the interest rate future. So I haven't taken the loan, I've agreed to settle to borrow at 6.21%. So first of all, I will calculate the basis risk, which is 6.21 minus 6, which is 0.21%. And I know that from 6, which is the current spot rate, my assumption is that the interest rate will converge towards 6.21. Now this basis risk is in 3 months period. So I am considering of closing the contract after 1 month. So the second step is I will calculate the remaining basis, which is 0.21, which is the difference, divided by the total number of months, which is 3, into the number of months which are left. Remaining is 2. So I take that and I do calculations and I will get 0.14. So my remaining basis is 0.14. Now let's assume that at the time of 3 months, so at the time of 1 month, after 1 month, the market rate is, interest rate is 5.50%. So I'm closing the contract after 1 month. So after 1 month, the market rate is 5.5%. So since the interest rate is increasing from 6 to 6%, 6.21%, So I will be adding the remaining basis of 0.14 and I will write 5.64%. Now I will see, so what is the gain from this contract? So I have sold my future, so I took a sell position at 6.21 and now I have taken a buy position at 5.64 and the difference will be 0. Calculate that. That will come out to be 0.57. So this is a value that will come out. This is the gain. Now the next step that you will have to do is to convert it into ticks to calculate the gain. So to convert it into ticks, what you have to do is, so I have now just calculated 0.57 as the gain. Now the next step that I'll have to do is I'll have to convert it into ticks. So to do that, since they have given me that the tick size is 0.01%, I will write 0.57 over 0.01%. As a result, I will get 57 ticks. They will, in the question, they'll give me that each tick is worth, let's suppose, $10. I'm just assuming. So I will write 57 into $10 and the gain I will get is $570. So once I've gotten this, I will now calculate. So after 1 month, due to closing this contract, I've gotten a gain of $570 from this future. So I will just repeat the steps. Number 1, you first calculate the basis risk. Then you calculate the remaining basis at the time of closing. Then you add the remaining basis, add or subtract the remaining basis from closing rate. After that, you calculate the gain or loss. After that, you calculate the tick value based on tick percentage. And after that, you calculate the gain value, which is the ticks, the number of ticks into tick dollar amount into the number of contracts. So in our case, we had just entered only one contract. As a result, we wrote 57 into $10 into 1, which is $570. So it is very important that you calculate this amount. Now remember, this benefit is on our interest payment. So whenever we'll enter the contract, this gain will be deducted from our interest payment to calculate the effective cost. I hope this is clear and these steps are also clear to you. And if not, it is recommended that you pause the video, you look at this video carefully and try to understand these concepts. The seventh tip, which is fairly a simple tip, is knowing the contract formula. This is a mistake students often make. So what is the amount of loan over the contract size into the time period for which you require the contract over the duration, which is typical since the future, this is 3 months. So you need this formula to calculate the number of contracts in a future. So remember, this is very important. So for example, if you have a 10 million contract and 10 million amount that you want to hedge a loan against, and the contract size is 500,000 pounds, and you multiply it with the number of periods. Let's suppose you want it for 9 months and 3 months is the duration of that future, and you can do this hedging, you do this calculation to find out the number of contracts. This comes out to be 60. So now we will talk about tip number 8, which is interest rate options. And just like currency options, we have a call and a put. A call is a right to a buy future, which is often taken by lenders, and a put is a right to sell futures, which is taken by a borrower. So when will a lender take a call option? When he is apprehensive that the interest rates in the future will, or in the upcoming days, will fall. And when will the borrower take a put option? When he is apprehensive that in the future the interest rates will increase. So you take a call when you are fearful the interest rates will decline. You take a put when you are fearful that the interest rates will increase. And just like in futures, we calculate the number of contracts. You use a similar formula for interest rate options as well. Now, in addition to a future and an interest rate option, since you have the obligation, you don't have the obligation to exercise. So you could either exercise or you couldn't exercise. It's up to you. Therefore, they charge a premium for such services. And the premium is basically calculated on this formula. So a tick value will be mentioned in the question. You will use that, and they will also provide you a ticks, how many ticks are with that specific contract. And they will also give you a tick value, that how much is each tick worth. And then you multiply it with the number of contracts to calculate the worth of that premium cost of that. So again, if you're fearful that the interest rates will rise, then that means prices of futures will fall. So the mechanism of when to put and when to call is very important. This is a confusion students often have. That is why I'm repeating it again and again. So if you're fearful that the interest rates will rise, that means prices of future will fall. So if the prices of future fall, as a result, you take a put option. When the assets are following, you take a put option. If you are fearful that the interest rates will fall, so this was when the interest rates will rise. But if you are fearful that the interest rates will fall, then that means the price of futures will rise. And in such a scenario, you take a call option. You take a call option when you are expecting that the underlying asset price will increase. So this is very important that you need to know about. So let's take an example to understand the basic calculation of put and call option, which are important. Let's suppose we have a put option at 94. So if we have a put option at 94, what does that mean? That you have the option to sell a future, take a sell position future at a rate of 94. And let's say that we have contracts of 5. We have 5 contracts. The contract size is $500,000 and the premium cost is 0.255 ticks annual percentage. So if this is given, what will be the gain if the market rate changes to 7%? So clearly, if the market changes to 7%, that means 100 minus 7 is equal to 93. That means I'm selling at 94 and price of future falls. So I will get, I clearly know that I will get a gain in my put option. Now how much will that be gain? To calculate that, first of all, what you do, you calculate the premium. So how do you calculate the premium of this put option? For that, you write premium. And first of all, you write 0.255% ticks into the number of contracts, which is 5 into $500,000. This is how you calculate the premium cost. And since this is an annual percentage and our contract is, let's suppose, for 3 months, therefore we multiply by 3 by 12. So I will get a value of $1593.75. So this is the cost that I have to pay. Now what is my gain? To calculate my gain, I will see what is my closing spot rate. So let's assume my closing LIBOR spot rate is 7. But before I can calculate that, I need to know my basis risk, which is remaining. So let's say my remaining basis risk was 0.07. So I will just write 7 plus 0.07 and I will get the closing rate, which is 7.07. Then I will deduct 7.07 minus 6, which was the selling rate, and I will get a rate of 1.07%. I will take this 1.07. How do I found the 6 value? Simply knowing that we are selling the future at 94, that means 100 minus 94 is equal to 6, and this is the 6% interest rate at which we are settling. So once I found 1.07, what I will do, so I just calculated 1.07. I divide by the tick size percentage, as you remember in the previous steps, that was 0.01, and I will get a value of 1.07 divided by 0.01, that is 107. So my gain is 107 into 5 into the tick value, which let's suppose it was $10. So I will get a gain of 107 in 10 to 5, which is the number of contracts, which is 5350. So exercising this will give me a gain of 5350, and I will deduct a premium cost of 1593.75 to get the overall gain, which is from this contract, which is $3756.25. So look at this and understand these concepts. If you have confusions, I recommend that you pause the video, you go back and see it again, and if you still have confusions, then please email me. So it's very important that you know how to understand the basic calculations of a put and a call. So as an exercise, I recommend that you look at put and call options and understand their gains and losses. Now, the third thing that you need to know about, just like, is a collar. What is a collar? A collar is when you take two positions. You take a buy. If you take a buy position in a put, you take a sell position in a call. Or if you take a sell position in a put, you take a buy position in a call. So you do the opposites. So you take two options simultaneously. That is called a collar. And the most famous collar is called a borrower's collar, where you buy a put and you sell a call option. So why do you do that? Because the purpose of doing this is so that you're able to finance your put through selling a call. So you're apprehensive that the interest rates will increase. So what do? You buy a put and you're sure that the interest rates will increase. Therefore, you have no risk, and you think that there's no risk, and as a result you sell a call option. So when you sell a call option, you'll get a premium, and you use this premium, you receive premium, and you use this premium to pay for the put option that you have just bought. This is called a collar. The benefit of this collar is that it limits the upside and downside loss. So you can say it's a benefit and a disadvantage. The benefit is, since you have paid the premium, the cost of put option is reduced because you have sold a call to finance it. The downside is that what if the interest rate falls? Now if the interest rate falls, clearly you're not going to be exercising the put option, but you will be forced to comply to the call option. As a result, the gain from lowering interest rate may not be capitalized. By buying a put option, you had restricted the loss, the downside loss, because you had a put option which allowed you to get a loan at a specific rate. But when you only had a put option, you had given yourself the excess that if the interest rate falls, I'll be able to benefit from it. But when you buy a collar, in a collar you have sold a call. As a result, you get a loss when the interest rate falls from selling the call. So this is a concept of a collar that you need to know about from a definition purposes, because in definitions they tend to ask you what a collar is, and therefore you need to know that it is about buying a put and selling a call. If you have confusions, again I'm repeating this again and again in this lecture video often, although I do it in all other videos as well, but because it's a very complicated topic, interest rate futures, and I want to make sure that you are absolutely clear about this concept. So when you buy a put, we consider this, especially a borrow call, a cap. And when you sell a call, we call this a floor, because you are limiting on your upside gain and downside loss, and as a result that is called a cap and a floor. By buying a put, you're putting a cap on what? On your downside loss. And by buying a floor, you are putting a limiting on your upside gain. As a result, this is called a call. And finally, you need to know about very important thing, that is the interest rate swap. What if you are two parties and you want to exchange your interest rates? So what is swap? Swap is when one gets a floating rate and the other gets a fixed rate. And how do they get it? So A has the option of either taking a floating rate at LIBOR plus 1.5% or a fixed rate at loan at 9.25%. And B has the option of either getting a floating rate loan at LIBOR plus 0.5% or a fixed loan at 7.25%. So what happens is, A takes a floating rate loan at LIBOR plus 1.5% and B takes a fixed loan at 7.25%. And now both parties, A swaps its interest payment with B and B swaps its interest payment with A. So as a result, what will happen? Both will gain from this swap. That is what's happening. So let me show it in a picture, so that's much more easier for you to understand. So this is A. So he goes to the bank and gets a loan of LIBOR plus 1.5%. So each year A has to give the bank LIBOR plus 1.5%. And B has to take a loan from the bank at 7.5%. Now both parties agree to do a swap. What swap do they agree on? B agrees that I will pay A LIBOR plus 1.5%. And A agrees that I will pay B 9%. Now if they do this swap, what is the benefit to each other? The benefit to A is, if you look at it, A has to pay, so A is paying LIBOR plus 1.5% to the bank and A is paying 9% to B and is receiving LIBOR plus 1.5% from B. So paying and receiving. As a result, the net payment of A is 9%. Now if you look at the swap, the benefit of the swap is that if A had taken a fixed loan, it would have paid 9.25%, but due to the swap, it's paying 9%. Similarly, B would have to pay bank 7.5%. B would receive from A 9%. So B would receive from A, receive 9% and pay LIBOR plus 1.5% they'll have to pay. Now if you take the net total, so B in essence is doing what? B has to only pay LIBOR. So if you do it, it has to, these are two minuses and this is a plus. and if you add them up, it becomes LIBOR. So if B himself had taken the floating, it would have gotten LIBOR plus 0.5%. But now it is getting LIBOR. So by doing the swap, B is benefiting by paying a lower interest rate. So what is happening? People swap at an agreed rate in such a manner, they do that agreement in such a manner that it costs them less. So remember, the idea is that it costs them less in comparison to directly applying. So if A had directly applied for a fixed loan, it would have cost him 9.25%. So rather than directly applying, they entered a swap by doing what? By applying for a floating rate loan and then using that swap to pay 9%. So this is the benefit of swaps that is taking place, that rather than applying directly and getting 9.25%, you applied indirectly by first applying for a floating rate loan and finding a buyer that wanted a floating rate loan and wanted to give you a fixed rate payment. And as a result of this exchange, we did this and we understood the concept of interest rate swaps. Again, swaps is the exchange of interest rate between two parties. So if you are not clear about this concept of swap, it is very important that you should know so. But if you're not clear about the concept, please re-watch this video. If you're still not clear, then please email me and I will try to clarify your concept further. And finally, the last tip that you need to know, although not often tested, but still I want the students to be able to know, is a currency swap, which is an agreement between two parties to exchange the principal amount of loan and the interest in one currency for the principal amount and interest in another currency. So in the last one, we were swapping what? The interest rates. In this currency swap, we're not just swapping interest rates, we're also swapping the loan amount as well. So there are two companies, Barrow and Greening, and these are the rates available to them. So if Barrow takes a US dollar loan, it costs them 3.6%. And if it takes a euro loan, it costs them Euribor plus 1.5%. On the other hand, Greening, if it takes a US loan, it costs them 4.5%. And if it takes a euro loan, it costs them Euribor plus 0.8%. So clearly, Barrow has a benefit of taking a loan in dollars, and Greening has a benefit of taking a loan in Euribor. So rather than directly applying for a euro loan by Barrow, what Barrow does is it applies for a US loan and Greening applies for a euro loan, and then they swap their loans with each other. As a result, both parties benefit from this exchange because Barrow is able to get a loan of euro at Euribor plus 0.8% and Greening is able to take a loan at US dollars for 3.6%. So in essence, Barrow takes a loan in dollars and they exchange their principal and interest rate. So these are the 13 tips that are extremely essential that you should be knowing about. If you have confusions regarding any of these tips, it is recommended that you do further understanding of these concepts and it will be very much beneficial for you.
If you like this video, visit our website www.SKANSECampus.com to purchase the complete course at affordable prices. Register today at no cost and access our free 10-day trial.